Okay, folks, so I want to continue the discussion about the level two because I want to make sure that you are very clear about the dynamics of the market. Okay, so firstly, the market as it stands works by matching orders. So think of the market as a gigantic electronic system that matches up buyers and sellers. Someone wants to buy, someone wants to sell. This is actually the way that the system has been designed to work. So we have what are called bids, which are are orders they're looking to buy, and they give a quantity of what they want to buy. And we have asks or offers, which are showing a quantity of what they want to sell and at what price they want to sell at. Now, keep in mind that if we don't have anyone willing to move from where they're bidding or where they're offering, no transactions would ever take place. For example, whenever real estate deals are done, whether it's commercial real estate or residential, somebody has to be willing to accept the price that the other person is making available. So if I'm selling my real estate, the buyer either accepts my price or they negotiate a lower price to buy at. And if I'm the, if vice versa, if I'm the buyer of real estate, I either accept the price that the property is currently available for, or I negotiate to buy at a lower price. The buyer's always trying to buy at a lower price. The seller's always trying to sell at the high price. The only thing that dictates which price I end up buying or selling at is what I'm willing to accept. In other words, I do not have to buy, nor do I have to sell unless there's some situation that makes me need to buy or sell. So, for example, if I'm in real estate, or sorry, if I own a property as a real estate investor and that property is going sideways and now I'm starting to lose money and I can't afford to keep it, then I have an urgent reason to sell. So I'm a very, so as they will say in the ads, very motivated buyer. What does that mean? The buyer needs to, very motivated seller. What does that mean? It means the seller needs to get out quickly. So maybe they're moving to a new location, or maybe they're upside down on their mortgage, or whatever it is. If they say they're motivated, it means they're aggressively trying to get rid of the property. If it says motivated buyer, it means someone who, for some reason, really needs to get into a particular property. Maybe it's because they're convinced that the value of the property is going to go up very quickly and there's a lot of competition, so they don't want to wait. They know other people are trying to get into that property, so they're aggressively trying to buy. Or they maybe they are in desperate need of a place to live because they're coming from a different area and it's getting kind of late and they need to be able to make a move quick, so they're going to get more aggressive in buying, right? So in short, we all know about this. We're all familiar with this idea from regular life. All the stock market is a giant order matching system, and the bids are people who are passively trying to get in. Sometimes they're going to be more aggressive. It's like in other words, if my bidders keep changing their bids, they keep moving them around, it means they're actually trying very hard to catch someone who wants to sell. If the offers, the asks are moving around a lot, people are consistently chasing after the market with their offers, their asks, then that means that there's more urgency for them, but they're still not willing to do it at market price. In other words, they're refusing to accept the market price. In other words, if I'm trying to sell, I'm refusing to sell at someone else's bid. Or if I'm trying to buy, I'm refusing to buy at someone else's offer. If I'm trying to buy, I may keep moving my bid up until someone finally says, okay, I'll sell to you. Or if I'm a seller, I may keep moving my ask down until someone's willing to buy from me. But I'm not going to move it to the bid, because if I did that, I might as well just sell at the current bid. Or if I'm the buyer, I'm not going to move my bid up to the current offer, because otherwise I might as well just do a market order to buy. The market order is when someone completely capitulates to whatever is available now. When you do a market order, you're literally saying, I will not wait one moment. I will get in to buy at this offer, I'll sell at this bid, and I will do it now. That shows urgency. That shows that you are convinced that you need to do something right now, that you're not going to wait. But as I said in the previous video, if I see a lot of mixture of green, white, and red over here, I shouldn't be that determined to get in, because this is telling me that I'm probably going to get another chance to get in at a slightly better price and just wait a little bit. But when I see a massive red or massive green and it's just flooding in, that's when I have to act faster. That's when I probably need to sell at market if there's a lot of red, or buy at market if there's a lot of green. Because if I wait, it may not give me a good opportunity to get in. I may miss it altogether. So whenever you see stocks moving up very quickly, it means you have a flood of green. And if you see a stock moving down very quickly, you have a flood of red going on. Okay, when it's just kind of gradually moving up or down, that's when you have a mixture of both. Now, the only way the market can move is if there are enough market orders to buy to move through the available offer, the available ask. So if the ask is only 100 or 200 shares size, all it takes is me buying 200 shares to move through that offer, that ask. So in other words, if the ask is someone trying to sell 200 shares at 197.24, and I say I'll buy 500 shares right now at market, I'm going to go through that order. I'm going to actually buy more shares than are available at that current order, which means my transaction is not going to execute all at one price. It's actually going to spread out until I get filled. So in other words, if there are 200 shares available at one price at the ask, then the next available ask has another 200 shares, and the next available ask has another 200 shares, then if I have a 500 share market order that I just placed, assuming I'm the only person who did it at that time, I'm going to have to move through two bids, or sorry, two asks. They'll get taken out. So the first 200 shares I buy, then the next 200 shares I buy, and then I buy half of the last one, because the last one had 200 shares, but I only have 100 shares remaining. So in short, if there's a 30,000 share ask sitting right here, it's going to take 30,000 shares of buying to get through it. And then once you do get through it, you have the next available ask, and the next one, and the next one. So if someone were to suddenly do something which they would never do, let's say someone hypothetically has enough money to buy 20 million shares of this stock. And let's suppose they placed a market order right now to buy 20 million shares of Tesla. If they did that, they would not be able to execute that trade anywhere near where the price is now, because there are not enough shares available to satisfy that size of an order. In other words, you only got 4,000, 5,000, 100, 300, 1,000 shares. That sum total is not going to come anywhere close to 17 million shares. So no one would ever do that, because if they tried, there'd be no way they could get filled anyway. And that even assumes that the trading firm they're going through would even accept that order. In fact, I can guarantee the trading firm would automatically reject that order. They wouldn't let it go through, because they would know the impact on the market would be so great that the buyer would instantly put themselves into a massive loss, where suddenly the price would go up so much that their average entry price would be so high that they would never really be able to make money. And of course, when the market goes against them, they're going to start losing money. And at that size of a trade, there is a good chance that they may not have enough money to cover the losses. And of course, if the client can't cover the loss, then the broker has to cover it. And of course, the broker never wants to cover losses, because that comes out of their money. And they don't want to lose money, right? So in short, the reason why we don't see these massive size trades going off all at once is because all the participants understand that you can only execute as much as what's available. So what they'll do instead is they'll execute orders of that size in chunks, small chunks of, if 500 shares here, 2,000 shares there. They'll just gradually do it. And for a trade that size, if it was 17 million shares, That's never going to happen in one day. That's going to take days and days to fill. Why? Because you don't have as many shares available to buy. There's other people competing to buy those shares. You can't just grab them all up yourself. So therefore, you're going to have to gradually move through the market and execute that trade over time. So that brings up the major point I'm trying to make about size. Larger size trades will move the market faster. In other words, if you get a larger number of buyers, at the market order buys or large number of market order sells, the market price is going to move a lot faster. It's going to move a lot quicker. When you have smaller size orders like 100 shares, 200 shares, etc., the market's going to move slower because the available offers and bids will be large enough to mostly absorb. But still, every time an order is large enough to take out an ask or take out a bid, that moves that bid or ask out of the way, and then you have to go to the next price. And that's what makes the market actually move. It moves up or down because people are buying up enough shares to move up the offers or selling enough shares to move down the bids. And of course, since buying and selling is happening at the same time, it's whatever side is more dominant that's able to move through its side of the market better than the other side. So in other words, if the bids are really, really large and the asks are really, really small, it's more likely the market's going to move up because when the sellers hit the bids are going to be so large that it's going to absorb most of the selling. But if the offers are relatively smaller, it won't take as much pressure to move the price up. So the price will likely go up because it's the path of least resistance. If there's fewer offers and much larger bids, you're more likely to see the price go up, right? Doesn't mean that there won't be large sellers selling at those bids, but generally speaking, you're going to see more of an ease of the market to go up in that situation. Likewise, if the offers are really large, the asks are really big, but the bids are really small, you have a tendency for it to be much easier for the price to go down because it has less resistance to movement. Okay. So, in short, think of these orders like bumps in a road. The bigger the bump is, the slower the vehicle has to move over the road. A very bumpy road, you can't drive very fast. A very smooth road, you can. So, if the bumps are very small, the vehicle can go a lot faster. If the bumps are very large, the vehicle will be slowed down unless the vehicle is so big that those bumps don't look that big to it. So that means that if the offers or the asks are very large, but the number of people buying, the size of the buyers is equally as large, then they're able to overcome that. They can actually move through larger offers or asks fast because the size of the buyers is so large. Okay. So that concludes this lesson, right? Remember that nothing ever moves unless there are enough buyers to buy through the asks or enough sellers to sell through the bids. Otherwise, the market can't move. And most of the reversals that you'll see in the price of a stock are going to happen when you hit a major level where there's large amounts of buyers or sellers waiting to get into the market. That's usually where the reversals occur in a stock. So if you can see them by looking at this, you can recognize where they are and wait for the right moment to take advantage of that potential reversal. But if you don't see that, if you're looking at a chart, you won't know that that level is there until after the market's already turned around and went up quite a bit. And then way after the fact, you'll know, oh, there looks like there was some support there. But with this, you can actually identify it much faster, as well as get a general sense of whether there's extreme pressure to buy or sell, or if it's more normal pressure where you can wait and be more patient at getting in and out of trades. All right, hope that helps, folks.